Is Meta a buy at $600 per share? And if you want to build indestructible generational wealth, is Meta a good choice as a long term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of Meta based on their recently reported 1Q 2025 results. Trading at $600 per share, I have a hold rating on Meta stock. In my research, I discovered 6 things that got me very excited and 5 red flags to watch out for with Meta. So what did I discover? What is my value for Meta stock? And what is an ideal entry point should you decide to become a Meta shareholder? In this video, I will cover Meta's recent results and what everyone is missing, what I think about Meta stock and what my analysis uncovered, what Wall Street's smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. Meta crushed estimates with amazing 1Q25 results, and I'm going to break it all down just for you. Let's cover the red flags first. The trial began on April 14, 2025. The Federal Trade Commissioner, FTC, accuses Meta of maintaining an illegal monopoly in the personal and social networking market through its acquisition of Instagram in 2012 and WhatsApp in 2014. And a ruling against Meta could require divestiture of both platforms and set a major precedent in future tech antitrust trials. 4.2 billion in quarterly losses in 1Q25, over 1 billion per month in burn rate. There's no clear revenue path for AR, VR, or Quest.
Holy fudge, what a hit.
The European Commission declared Meta's no-ad subscription model to be non-compliant. A major revenue impact is expected in Europe in Q3 2025. And US regulators are investigating AI training data for copyright violations. Asian advertisers are cutting US spend due to tariff shifts. Management hinted that this impacted their Q2 outlook. Full year guidance was raised from $65 billion to $72 billion. It's mostly going into data centers and infrastructure for AI. That's good long term, but it pressures short term free cash flow.
There are red flags everywhere.
Here's what got me really excited. Massive profit growth. Net income surged to $16.6 billion, up 35% year over year, driven by stronger ad pricing and volume. Operating margin expanded to 41% and operating income grew 27% year over year, driven by high margin ad revenue and a 10% increase in ad prices.
Now we're talking.
Meta AI already has 1 billion monthly active users. The new standalone app just launched with social feed and personalization layer. Monetization is going to follow the Facebook playbook where they scale first, then do ads, and then cover premium later. New generative ad recommendation model, or GEM, is 2 times more efficient. They already rolled it out to Reels, driving a 5% increase in ad conversions. Streamlined campaign creation with full AI automation, a 46% lift in incremental conversions from new attribution modeling. This is a hidden driver of pricing power and return on ad spend.
Let's talk about money.
Over $70 billion of cash on hand, share repurchases were $13.4 billion, and dividends were over $1.3 billion in 1Q25. This is a story of shareholder-friendly capital allocation while scaling AI. This is what everyone is missing. Meta is replacing NVIDIA and AMD with in-house silicon. MTIA now powers ad ranking and Gen AI workloads. This provides a long-term moat for compute efficiency and independence.
Thanks for the heads up.
When it comes to any stock, I let the numbers tell the story, and that involves looking at a company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
I said not today.
That is what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see what I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year-end, Meta had almost $44 billion in cash, and if we add marketable securities, it's almost $78 billion. This gives the company a ton of money to invest in the future, whether it's AI or the metaverse. We're going to see this later on in the cash flow statement. PP&E increased over 25% since 2023, and it's projected to nearly triple in 5 years by the end of our model. Meta has massive CapEx plan with their commitment to AI infrastructure build-out. While the company paid its first ever dividend in 2024, retained earnings increased by almost 25% to over $102 billion. The fact that the company can pay over $5 billion in dividends while still growing retained earnings is impressive. So what's the takeaway? Meta has tons of cash, its debt is manageable, and it's returning billions of dollars to shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues go faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Meta generated a massive $164.5 billion in revenue, with 97% coming from advertising. Revenue growth was almost 22%, the highest level in 3 years. Margins expanded across the board, which is a tremendous positive showing operating efficiency. After a rough 2022, Meta reached margin levels in 2024 that it has not experienced in 6 years due to layoffs and aggressive cost cutting. Meta achieved net income of $62.4 billion in 2024, more than the last 2 years combined. Because the company has aggressively cut costs, more money flows to the bottom line, which is great for investors. So what's the takeaway? Top-line revenue growth over 20% combined with cost reduction means expanding margins and increasing profits for investors. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, and financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Meta is generating. While we see the increase in CapEx to fund the metaverse investments and AI initiatives, there's something amazing going on here. Marketable securities generated $15.8 billion, a more than 2.5x increase from 2023. Meta is generating billions from the nearly $34 billion of cash that it has invested in marketable securities. Financing cash flow is negative, but it's not primarily due to paying down debt. What is fascinating is that the bulk of the cash outflow is due to the massive amount of cash being returned to shareholders. $35 billion, or 86% of the total financing cash flow, was due to dividends and share repurchases, putting more money into shareholders' pockets. So what's the takeaway? With almost $78 billion in cash and cash equivalents, Meta is using those assets to generate income, which it is returning to shareholders and reinvesting in its business for the long term. So what does this all mean for the valuation of Meta stock? Let's cover that next.
I'm all ears.
On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take those future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. We strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value of approximately $1.7 trillion. We divide that by the current shares outstanding to get an implied share price of about $673 per share, compared to the current share price that is a 12.7% discount, which is a hold rating. On Wall Street, if a stock is trading greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you the ideal entry point to buy Meta later in the video. So what does Wall Street have to say about Meta stock? Let's cover that next.
This is Wall Street, Dr. Burry.
Overall, the consensus among analysts remains optimistic about Meta's prospects, particularly regarding its AI initiatives and potential advertising revenue growth. However, some caution is noted concerning increased spending and regulatory considerations. Barclays adjusted its price target downward from 705 to 640 due to concerns over regulatory challenges and increased capital expenditures. However, they maintain an overweight rating, citing Meta's strong position in AI and advertising. Bank of America raised its price target to 690 following Meta's strong Q1 results, emphasizing the company's robust AI strategy and advertising resilience. They acknowledge macroeconomic and regulatory risks, but maintain a positive outlook. JMP Securities reiterated its positive outlook and market outperform rating with a 750 price target on Meta, emphasizing the company's strong Q1 performance and potential for growth through AI and advertising innovations. CapIQ gives me a sense of how other analysts on Wall Street view the company. 62 analysts cover Meta on Wall Street, which is a lot. The target price is from a low of 466, which is a 22% decrease, to a high of 935, which is a 57% increase. Downside is greater than upside by 2.6 times. Hedge funds typically look for 2 times or greater. The median is 690, which is a 16% increase. The overall rating on a scale of 1 to 5 is 1.46, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do have a position in Meta. It's currently a 5.1% weight in my overall portfolio, and I was able to buy shares for under 500 in mid-April during all the tariff craziness.
Well, that's a bold move.
If you decide to buy Meta, I'll tell you exactly how to build a position, which I will reveal shortly. 16% revenue growth, 36% EPS growth. Meta is printing money again. 10% rise in ad pricing and global demand surge in Asia Pacific. Things are looking up. Meta is positioning itself to lead open source generative AI, which could become a $1 trillion vertical. Meta hit an all-time high of 741 in mid-February, and it's down over 19% since then. My model shows a value of 673, which is a 13% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Meta's a hold at current levels, but if you're interested in buying Meta, I would be looking to buy below 565 in the 560 to 565 range. If you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position.
There's actually some great advice in there.
Meta is the only diversified pure play social media company out there, and their integration of AI into advertising is already bearing fruit. While the metaverse is a few years off, Meta is leveraging their success in the rest of the business to fund the future.
Because the future is now.
If you like this and want to see another in-depth stock valuation, check out my HIMS video here or my NVIDIA video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.